Archbishop, Pro-Director, distinguished guests, ladies and gentlemen, welcome to this, what is now the 10th annual lecture of the Hellenic Observatory here at the school. Over the years, we've hosted a number of very prominent public figures. We've had the pleasure of hosting the Ecumenical Patriarch, Prime Ministers Kostas Simitis, Karaman Lis. This summer, we hosted Yorgos Papandreou. We've hosted a number of ministers, Yorgos Alagouskoufis, Dora Bakoyannis, Yannis Papandreou, and a number of very distinguished academics. For this evening's lecture, we wanted to take account of the fact that, as it were, the world has been turned upside down in recent times by the global financial crisis. At the same time, the banking system in Southeast Europe has appeared to be relatively insulated from the dramatic crises we've seen in the West. And that bears further attention, further consideration. We recognize also that Greece's economic position in Southeast Europe has changed on a long-term basis. Her major banks have invested heavily in neighboring states. And in fact, the entrepreneurship of Greek banks within Southeast Europe has been little short of stunning. There's been no more prominent player in this respect than the Ethniki Trapeza tis Eladas, the National Bank of Greece. Under the tenure of its previous head, Mr. Karantzas, and now its present chairman and CEO, the bank has consolidated its position domestically, and the bank has emerged as a regional leader. The bank has seized the opportunity for expansion, helped, of course, by a world of global liquidity and foreign portfolio investors seeking attractive rewards. In doing this expansion, the bank has clearly protected itself against foreign acquisition. The National Bank of Greece has maintained its Greekness, as it were, maintained its role as a national champion. A few years ago, in 2006, the bank hit the international headlines by making a €5 billion bid to acquire Finansbank in Turkey. An audacious move which meant that a Greek bank now took control of the fourth biggest privately owned bank in Turkey. NBG, in other words, has helped to create a new climate of some economic interdependence across the Aegean, whilst also consolidating national pride in Greece about a strong and extrovert Greece within the region. Also, alongside this strategy, the bank has expanded very much in the rest of the Balkans, Serbia, Romania, many other countries on Greece's northern borders. The NBG chief who has led this expansion is our speaker this evening. We are indeed honored to welcome Takis Arapoglou to come and speak for the lecture, the 10th annual lecture this evening. Mr. Arapoglou has had a long career in international banking, including several years as the global head of the banks and securities industry for Citigroup here in London. His career has switched several times between London and Athens. He was a founding member of the Hellenic Bankers Association here in London, and I'm very pleased that we have so many members of that Hellenic Bankers Association with us this evening to welcome him back. Mr. Arapoglou's reputation has led him to be invited to join several international bank advisory boards across Africa, North America, Europe, and to be chair or member of a string of cultural, educational, and business councils, institutes, foundations in different European countries. I can promise you the CV is an impressive list of professional and public achievements. So on behalf of the school, I'm very pleased to welcome our speaker. In particular, of course, also because the National Bank of Greece has supported Greek studies here at the school from the very beginning in the late 1990s. And this support has increased in recent years, with the bank helping us to develop a stronger focus on Southeast Europe. A focus which helps us to unite our chairs on Greek studies and contemporary Turkish studies. Takis Arapoglou has devoted much of his personal time and energy to supporting and advising the LSE in these endeavours. I'm delighted that he is a member, a long-term member, of the advisory board to the Hellenic Observatory. So I would like to record my own personal sincere thanks for his support, advice, and encouragement over the years. The school, quite simply, is welcoming one of its most cherished Greek partners this evening. And I can think of no better person to talk to us about how the banking crisis has played out in Southeast Europe, and in that context, the opportunities for Greece in developing its regional market position than our speaker this evening. Greece is indeed very fortunate to have a banking leader of such international reputation. Without further ado, please join me in giving a very warm welcome to the Chairman and CEO of the National Bank of Greece, Takis Arapoglou, to give our 10th annual lecture.
Thank you, Kevin, for your very kind words, yet highly exaggerated. Your Eminence, Your Excellency, Professor Gaskell, Professor Featherstone, distinguished guests, I'd like to thank very much the Hellenic Observatory and the London School of Economics for honoring me today with this invitation to speak tonight about Greek banks and share with you my thoughts on the future. The key theme of my presentation tonight will be the importance of a successful regional strategy for the future of Greek banks, mainly due to their need for size and diversification. I will begin with a short historical overview of Greek banking, delve very briefly into the distant past, so as to explain the deep roots of Greek banks in the region, as well as the more recent history of the creation of the modern Greek banking system in recent years, which put in place the necessary conditions for its current successes. Not to boast, but to reinforce the steady gains of the Greek banking system, I will also briefly dwell on the relatively limited impact of the ongoing financial crisis on Greek banks, and will end my presentation with some thoughts on the key themes for banks in view of the new challenges they will be facing post-crisis. The following three quotes from a paper by historian Elena Frangakis on Greek banks in the Eastern Mediterranean in the late 19th and early 20th centuries reveal that a regional strategy was important for Greek banks even then. First quote, both the Bank of Athens, established in 1893, and the Bank of the Orient, established 1905, where National Bank of Greece was a shareholder, ultimately came to represent French investors, a testament to the strong interest of French capital in the Ottoman economy, and their close cooperation with Greek investors in the Eastern Mediterranean region. Both banks were regarded as Greek banks, being both incorporated in Greece, with headquarters in Athens, and with Greeks participating in their capital. Second quote, a further important reason for their success was the strategy they had adopted, whereby they viewed the Ottoman, Egyptian, and Balkan markets, irrespective of different nation-state boundaries, as constituting a single regional market. Final quote, other key factors in the success of the strategy was the uniformity of the economic level of market development in the Eastern Mediterranean Balkan region as a whole, as well as the special features of this market that Greek banks could understand very well. Ladies and gentlemen, as you just heard, approximately 100 years ago, Greek businessmen and banks combined forces with Western European bankers and investors to establish and operate out of Athens regional financial institutions with operations in what is today the Balkans, Turkey, Greece, and the Eastern Mediterranean basin. Fundamentally, these ventures were targeting to capture Greek banking market share, essentially in trade finance and merchant banking, from the Greek business community in the Ottoman Empire, as well as in Alexandria, Athens, Bucharest, and Russia. A different backdrop from today, a different business model and rationale, different products, yet one common denominator, a regional approach within a large, fairly uniform region with a fairly uniform mentality. Greece on its own, irrespective of the phase it was going through at the time, was always perceived to be one piece of a broader, more complex, and more promising economic puzzle. In the ensuing years, the southeastern European region lost its seamless homogeneity due to disruptive global and local political events, successive wars, economic upheavals, and the eventual advent of the Soviet Union, put on ice any idea of regional development, of economic integration in the area. Many years, modern Greece was politically and economically isolated from its neighbors. Its banking system, primarily state-owned, was mainly an extension of the state catering to government needs. A few banks established a fragmented and at the end overall very limited international presence in distant countries, Australia, Canada, US, South Africa, in support of the Greek immigrant communities that flourished there after World War II. This demonstrably introvert strategy of Greek banks continued for all intents and purposes, always under a heavily regulated state veil, well into the early 90s. A confluence of triggering factors transformed in about 15 years the predominantly state-controlled banking system into probably the most competitive sector of the Greek economy today. These factors include the deregulation of the Greek banking market, especially that of retail credit, which allowed the rapid growth in credit cards, consumer loans, and mortgage loans, as well as the successive privatization of state banking assets. The fall of the Iron Curtain, the adoption of the euro, and all this within a prolonged period of sustained global economic growth. The then hugely under-leveraged Greek economy, coupled with booming economic growth and surging stock markets worldwide, enabled very successful private sector, publicly listed banks to gain very substantial market share from state-controlled banks, which even as late as the early 2000s remained inflexible, unable to respond swiftly to market challenges, and still effectively dependent on a heavily unionized and politically directed framework. At the same time, very successful banks such as Alpha, Eurobank, Piraeus Bank, among others, gained very profitable domestic market share while delivering consistently substantial returns to their shareholders. This was achieved both through organic growth as well as domestic consolidation in the late 90s and early 2000s, growth in scale and effectiveness. The emergence and rapid growth of highly profitable privately owned banks and their prospects for continued success attracted the attention of foreign institutional investors who over time became increasingly larger holders of Greek bank stocks, which by itself was a force for change, especially as regards transparency. The National Bank of Greece, by far the largest bank in Greece in the early 90s in terms of both deposits and loans, was by far the main loser of market share to the privately held banks at the time. NBG was the first state-controlled bank to begin to successfully respond to the challenge by starting to gradually rationalize its balance sheet and cost structure, starting in 1996 with the tenure of my predecessor, the late Theodore Karadžas. These reforms, which continued well into my tenure, and one could say still have some way to go, in combination with a series of subsequent placements in the market of government-owned shares by successive governments, resulted in NBG increasing drastically its competitiveness in the Greek market and becoming much more attractive to international investors. Today, foreign institutional shareholders hold over 50% of NBG shares, compared to less than 10% before 2004. NBG today continues to be a clear leader in deposits in Greece, while it ranks roughly equal to Eurobank in loans in the country. Interestingly enough, foreign-owned international banks with a long-standing presence in Greece were unable to follow local banks on this growth path. This was perhaps due to the fact that they never managed to gain meaningful market share in retail deposits and were unable to adapt to local market peculiarities. Greek banks received a timely kicker to their already rapid growth due to timely historic coincidences. By the end of the 20th century, with globalization well underway and only disrupted temporarily by the dot-com bubble, large Western European banks were beginning to acquire banking institutions in Central European ex-Soviet bloc countries such as Poland, Hungary, Czech Republic. Their interest in banks further east in Southeastern Europe, such as Romania, Bulgaria, Serbia, came later due to the delayed reform efforts of these countries, coming some 5 to 10 years later after those in Central Europe. It must be said, however, that though delayed, reform efforts in these countries were very ambitious, as the governments in the region strive to catch up with the EU-bound train of Central European economies. It was just at this time that Greek banks had developed the size, maturity, capital, and expertise to enable them to expand outside Greece, and the fact that their bordering countries offered opportunities at that moment was lucky, to say the least. Their expansion was facilitated by the extensive business activities developed by Greek entrepreneurs in the economies of Southeastern Europe, building on long historical, cultural, and trade links. Indeed, Greek banks during 2000-2005 acquired banking institutions in Southeastern Europe or established new branch networks. These countries were similar to Greece in the 90s, with underleveraged economies, notably very little retail and small enterprises banking exposure, and high growth rates. They provided Greek banks substantial earnings growth potential, complementing the already existing growth potential in Greece. As a result of this, Greek banking stocks began to have emerging market content, in tandem with the stability they offered through the EMU membership of Greece. The risk profile of Greek banks decreased overall, as the expected marginal returns were increasing. As the banks in the region were quickly snapped up, reflecting government's aggressive structural reform agenda, Greek banks also came to be seen as a play on this booming region. As a result, foreign ownership of the major Greek bank stocks increased even further, reaching over 50% in 2007. Yet the market value of Greek banks was still a small fraction of the market values of their Western European peers, operating within their own much larger, much more mature domestic economies. Theoretically, at least in view of the large difference in size and valuation, Greek banks were perceived to be targets for Western European banks willing to expand in another EU country, which would also provide access indirectly to Southeastern Europe. This, however, never happened in any meaningful way, principally due to the fact that Greek bank stocks were trading at a much higher price-to-earnings ratios compared with Western European banks, operating principally in mature markets with lower spreads. Any such acquisition would have been expensive and earnings dilutive to the acquiring bank. Only two relatively small institutions were acquired by foreign banks. Indeed, more often than not, and with very few exceptions, Italian, Austrian, Benelux, and to a lesser extent Nordic banks have been greatly challenged to adapt to the required mentality for success in most of the Central Eastern European and Southeastern European countries where they established a presence. In stark contrast, Greek banks were able to make substantial progress in consolidating their presence outside Greece and effectively operate as locally embedded banks as opposed to isolated subsidiaries of foreign banks. Contrary to their European peers, they maintained and empowered local management, preserving continuity and local expertise. In addition, central management in Greece was entirely familiar with the specific characteristics of emerging markets, Greece in itself having been an emerging market not so long ago. It is true to say, however, that up until 2006, the international expansion of Greek banks in Southeastern Europe was relatively modest in size compared to international standards, despite the combination of medium-sized acquisitions and organic growth. Earnings from operations outside Greece did not exceed 10% for any group. As such, international expansion was not transformatory. By this term, I mean an acquisition that results in a positive stimulus to the way the whole group operates. This remained true until early in 2006, when the National Bank of Greece, after studying carefully the Turkish market for 2 years, decided to acquire control of a rapidly growing, high-quality, middle-sized private bank in Turkey with superior management. Following the Turkish banking crisis in 2001, which resulted, as we all know, in the collapse and closure of a number of financial institutions in Turkey, the government took the opportunity to completely overhaul the sector. Surviving banks with clean balance sheets benefited from Turkey's strong economic performance in the ensuing years, grew their assets, their capital, and their profitability by leaps and bounds, and inevitably attracted interest from international investors, but also acquisition interest by foreign banks. For National Bank of Greece, it was the obvious market to look into. It's just around the corner. The successful conclusion of the approximately 3 million euros, $5 billion equivalent acquisition started a chain of important processes within the NBG group, especially on the operational structure, which had a sizable impact on its profitability, style of management, cost containment, and operational efficiencies, among many others. Above all, it enabled us to gain access to a well-regulated, unleveraged, fast-growing systemic economy of more than 70 million people, a market larger than Greece and the Balkans put together. This move, in more respects than one, took regional expansion one step further, was clearly for the bank transformatory. It placed National Bank of Greece in a different playing field from its Greek peers, placing it among the larger European competitors. To date, this acquisition has proven to be value-enhancing for our shareholders, as originally projected. 40% of our profits, annual profits, come from outside Greece, 30% from Turkey, 10% from Southeastern Europe. What better proof of the stability and soundness of the Turkish banking system than the fact that Turkey didn't have to provide a bank support package during the crisis. It's one of the very few countries that banks didn't require similar support to other countries. How have Greek banks been affected by the crisis? The expression, the proof of the pudding is in the eating. The recent international crisis provides tangible evidence that concerning the progress achieved by Greek banks and its regulators, and I must underline our regulators, during the past decade. For reasons we all now recognize, world economic growth started to slow down by mid-2007, with all the effects that we have by now experienced and extensively analyzed. Greek banks were an exception to what happened to banks in most advanced economies, which experienced large write-downs of capital and inflicted huge losses to their shareholders. Greek banks have been operating in growing markets, offering high-quality, sustainable core banking revenues, and had not been tempted to invest in strange assets to enhance returns, as was the case with most of their European counterparts. Neither did they have large exposures, if at all, in countries which experienced catastrophic meltdowns, such as Russia, UK, and the Baltics. They also proved that they were correct in their assessment that the macro picture for countries in Southeastern Europe and Turkey would prove to be much more resilient than what international analysts and rating agencies were expecting. A reflection of both macro and micro factors, including the strong structural and fiscal reforms and the existence of sound national banking supervisors, most notably in Turkey. Greek banks also demonstrated that they do possess, that they do possess well-functioning risk management systems across the respective geographies. Asset quality has deteriorated, but with the worst most likely over, the worst is likely to be non-performing loans at a level of 7 to 8%, where at the peak of the crisis, there were estimates closer to 20%. Greek banks also proved to be relatively more conservative than Western peers as regards liquidity and capital. At the peak of the liquidity crisis, Greek banks faced limited liquidity challenges, mainly due to the fact that they could not renew their maturing funding, given that international markets were closed. These limited needs were covered via relatively contained use of a government liquidity support package, as well as through the relevant ECB facilities. With the gradual reopening of the international markets, banks are in a very orderly fashion replacing ECB funding and government support liquidity through selling bonds and securities in the international markets. This shows that Greek banks still inspire strong confidence to Greek banks, to the international community. Regarding capital, Greek banks also had relatively high core capital ratios compared with their Western European peers. Here again, they made use of government support package to preemptively raise Tier 1 capital to cover capital needs arising from extreme stress scenarios applied to their loans. Today, they're taking turns in raising new equity to replace government capital and/or enhance, ahead of most of their peers, their capital adequacy in view of the anticipated much tighter capital requirements by international regulators. Looking ahead, Western European banks today are clearly not in an expansive mode. If anything, some of them will probably soon be selling off non-strategic assets to generate capital and free liquidity. This will offer the well-capitalized Greek banks a great opportunity to acquire new assets in the region. Today, the large pre-crisis gap in market valuation between Greek and EU banks has narrowed. For example, at the end of 2004, NBG ranked 38th among European banks in terms of market valuation. Today, it ranks 18th. Greek banks have an opportunity to narrow this gap even further, adapting to changing rules faster and benefiting from their presence in countries that look as if they will be back on a growth path fairly soon. Indeed, Turkey is expected to grow 3 to 4% in 2010, and Southeastern Europe, excluding Greece, by 2% in 2010, with the post-crisis potential growth rates above 4% per annum. This is a great opportunity for Greek banks to grow the statute further and broader in the European banking scene. After all, size matters greatly in banking as it creates economies of scale and scope. With size, however, come very complex organizational challenges that need to be addressed well in advance. Banks need to develop leaner, much more efficient organizations assisted by technology, modern management. They need to progress fast into integrating businesses, geographies, support and control functions, which is all the nitty-gritty of our business. And above all, they need to integrate the diverse cultures within these large multicultural organizations. Having moved on from the era where gaining market share, even to the detriment of profitability, was the only deliverable, we have entered an era where investors focus almost exclusively on profitability and future growth potential. Inevitably, therefore, cost control will be much more of a priority going forward. For Greek banks, this means that structural rigidities, together with higher legacy operating costs in Greece for these banks that originated from the public sector, need to be addressed and costs seriously contained. Many years of euphoria and strong growth in the top line, revenues, have inevitably covered a lot of inefficiencies and corporate fat, despite the extensive rationalization efforts that banks have already gone through in the last few years. I believe that this is now the time to clean this up. It is highly unlikely whether the anticipated global economic recovery will be strong enough so as to require banks to leverage up again their balance sheet as much as they did before the crisis. Moreover, higher capital requirements will make meeting pre-crisis returns on equity even more challenging, if not impossible. As such, especially in mature markets, the resulting lower revenue generation will exert even more pressure on cost containment to deliver the desired profitability. Otherwise, banks will have to take on much more risk to generate returns equal to the cost of equity. We must quickly face up the fact that when growth in the world economy resumes, it will be at a much lower pace than what we have been accustomed to, and in a much more constrained and regulated environment. Banks, like any other corporation, would therefore have to adjust swiftly their operating models to become more efficient for the benefit of their shareholders, their customers, and their employees. This will present us with an opportunity to review, rationalize businesses from zero base, redefine targets and strategies, and adjust more to a knowledge-based society where value-added products and services will replace the classic one-size-fits-all solutions of the past. This is a sizable task that will present many challenges, but there is no better time to press on with it from right now. And I guess this doesn't only apply to banks, it applies everywhere. Furthermore, I expect that the pressure on cost control will inevitably drive further consolidation in the European banking sector, initially at least within each country and then cross-border, in order to reap the benefits of economies of scale and related strategies. History and common sense acknowledge that Greece in itself is a small country to be able to afford many small to medium-sized banks which can successfully compete in today's globalized environment, offering at the same time acceptable returns to their shareholders. Inevitably, if they are to maintain their independence, they must grow bigger and faster, and they can do this by growing their presence organically and through acquisitions outside Greece, in countries they can understand, in markets offering above average growth prospects, and preferably in countries with larger systemic economies. The countries which fall under this description are certainly not the mature Western European economies, but some of the large emerging economies in Central and Eastern Europe with European prospects, as well as other systemically important emerging economies of the ex-Soviet bloc and the Eastern Mediterranean basin, more or less as in the late 19th century. Equally inevitably, however, an expansion in such countries, no matter how well planned and executed, will skew banks' risk profiles towards the riskier part of the spectrum. The obvious offsetting move as regards to this risk, as regards Greek banks, would be domestic Greek consolidation that will increase the EU critical mass of the banks that choose to grow in riskier markets. Therefore, domestic consolidation, in order to either control cost and benefit from synergies, or to offset a riskier profile as a result of the need to grow in riskier markets, is almost inevitable. The market, as always, will decide on timing. However, what I described above would be an ideal scenario. Real life rarely allows ideal scenarios to materialize. Real life is governed by a relative randomness, and final outcomes depend on many things, on markets, on circumstances, and above all, people. In view of these uncertainties, it remains of paramount importance that Greek banks continue to be profitable, to maintain access to capital markets, as well as keep liquidity for their domestic and cross-border activities. One of the biggest problems in emerging markets is that people keep money under the pillow. They don't trust banks, so funding, bank funding is very difficult. So developing a deep funding base and depositors in emerging markets is of paramount importance. Continued profitability and confidence in management performance over a long period of time will provide the flexibility for Greek banks to time wisely their moves within and outside Greece. Looking at a chart where we plot price-to-book value multiples against market capitalization, we notice that investors pay a premium for banks with an emerging market content and with a market capitalization between 30 and 50 billion euros. Large market caps trade at lower price-to-book multiples, basically because these are larger institutions, more difficult to manage, and can handle risk in a more inefficient way. The exception of high price-to-book multiples in the lower end of the capitalization scale obviously represents potential acquisition targets. For MBG, the Greek bank based in Greece with the largest market cap, around 15 billion, to move into the premium range of 30 to 50 billion, we would have to double our size. This cannot be done within a reasonable amount of time through only organic growth. Every move has to be measured carefully, planned and priced to provide incremental value, mitigating execution and integration risks, while at the same time taking care of the day-to-day business. It's obvious that this complex, continuous, dynamic optimization process requires composure, excellent controls, and above all, highly skilled, multicultural, gifted people with local and international expertise who know how to work in teams and are committed to hard work over a long period of time. Development and trading of human resources will therefore be center of the plate. The task becomes much more complex if one adds the need for compliance to the ever-changing international rules and supervision regulations, the stricter board and corporate governance requirements, which will all become more demanding with growth in size. There I must make a pause to say that Greek banks have made tremendous progress in the last few years in complying to international standards, capital adequacy, and liquidity requirements, as well as to universally accepted governance principles, which include all necessary checks and balances a board has to follow. This has had a tremendous impact on the reputation of the Greek banks to foreign investors. Last but not least, today, for many complex reasons, banks worldwide have to deal with their image within society. They have to shrug off as much as humanly possible the tainted reputation for the events of the recent past, especially in Greece, where although banks did not go bankrupt, they were accused in the wake of the global recession for lending carelessly to unprotected consumers, or even depriving liquidity from businesses in need of support. True or false, it is irrelevant. It will require, however, a long-term effort by banks to improve their image. Most certainly, mistakes, large or small, have been made, and from all sides, especially in a market like Greece that experienced tremendous growth in the past 15 years. Equally certainly, and in parallel to the strive to remain competitive and profitable to their shareholders, banks in Greece and the world over need to substantially increase what they give back to society. And by this, I society a larger share of profits for the support of worthy causes, which we must. I mean also abiding by stricter environmental criteria for development, but more importantly, offering corporations and consumers transparency in terms of new products and services. I also mean supporting more proactively customers who demonstrably are in need of financial support in view of the difficult market circumstances above and beyond the letter of the law. Ladies and gentlemen, the world has changed a great deal during the course of the last year. In most instances, it has changed almost irreversibly, at least for the foreseeable future. As such, we need to adjust the way we do business into a more complex, more balanced model, which inevitably will include economic growth combined with more qualitative, intangible characteristics that cater to the fundamental values in life. I believe that Greek banks will face up successfully the new challenges. They will increase their size and presence more effectively than many other European competitors and play a greater role, as they were always destined to do, in the integration and development of Southeastern Europe and the Eastern Mediterranean region. Thank you. Thank you very much.
Thank you very much for a talk with such authority and clarity. I found the trends and the issues you're raising fascinating. Perhaps I could begin by drawing two possible implications of the many implications that you developed. Firstly, of course, I took from this your argument towards the end that the model of banking has to be changed so much, and that the emphasis must be on cost containment. Would you envisage cost containment in the context of the National Bank of Greece involving fewer, lesser staff in the coming years? Is that an area of cost containment? And the second question I'd raise would be that you emphasize the importance of the region for Greek banks, large markets, dynamic markets, developing economies, etc. Should we assume that the National Bank of Greece might consider further acquisitions in Turkey, for example, because it meets that criteria on many aspects, and whether we could see that on the future agenda. So before opening up, and I'm going to invite questions in a moment, I wonder if I could ask you to respond to those two, please.
Cost of personnel cost is not necessarily the obvious thing to go for. With technology, you can simplify processes, but you won't necessarily end up needing more or less people. But one of the most important benefits of running a much larger group comes in procurement, for example. The larger you grow, if you want to buy laptops for the group, I'd rather order 3,000 laptops than 50 laptops for Albania. So when we decide to buy laptops, we buy big size and we achieve tremendous discounts. So procurement is one. Technology and centralizing facilities and freeing up branches from daily chores that can be done by someone at the center increases productivity which is another way of controlling cost in a way. So the answer to the question, it's not necessarily related to reducing employees.
Thank you.
In terms of further acquisitions in Turkey, I think we have the critical size not to increase by acquisition in Turkey. Acquisitions are extremely difficult to absorb, are extremely tricky to integrate. We have a very successful team in Turkey, extremely good management and employees, a very strong culture, and we think now we have the critical mass to go alone in the next few years. When we bought the bank had 200 branches. Now we have 420 branches. So we've got the critical mass not to need a new acquisition.
Thank you. Questions now from the audience. If you could please raise your hand. There's various colleagues around the theatre, upstairs and downstairs, with microphones. If you could just simply identify who you are and then ask the question. There's the gentleman right on the very front row, please. Could we take several questions together?
Absolutely, yeah.
Please.
Hello, Mr. Arapoglou. My name is Lucas Piliotopoulos. I'm a Greek student at LSE. I would like to kindly ask for your view of the Greek gross domestic product and your opinion on the budget deficit in the future. Thank you.
Thank you.
Well, I'm not an economist, I'm an engineer by training, so I'd rather not make predictions on things which are also highly sensitive. Thank you very much.
Very good. A suitably veiled answer, thank you. There's someone up here. I thought I saw someone waving hands. Gentleman here, please. On here.
Will Bartlett, Lisi, a research fellow. It's a very fascinating story of expansion into Southeast European countries and Turkey and potentially beyond. When you expand your branch network in these countries, do you find there are problems of attracting suitable staff and the question of skills and training? How do you deal with that issue?
Thank you.
Can we get more questions?
Okay. The lady at the very back.
Thank you. Good afternoon. Fodini Kazi from Απογευματινή newspaper. I would like to ask regarding the acquisition of Finanzbank. Do you feel justified nowadays, after all this time has passed, for the acquisition of this bank? And how do you believe that the results of Finanzbank will contribute to the 2009 expected results for the National Bank of Greece? And if I can make a second question as well, regarding the measures, the new measures of the government relating the small and medium enterprises, what do you believe the effects of these measures will be to the market? And do you expect anything from your meeting with the government? I mean, the Association of Greek Banks with the government in a couple of days. Thank you.
Do you want to take this now?
Yep. Attracting staff, it has never been one of the main visions of this group, as stated on our website, is to be able to be an employer of choice in the region. In 2004, we had 20,000 employees. Now we have 35,000 employees, 35,000 families in the region. It's a huge increase, which has increased not only by acquiring other banks, but also by hiring people. And we have been able to hire extremely talented people across the three regions that we operate in. At the same time, we're trying to centralize human resources management and training. We are not where I would like us to be, but we have made tremendous progress, because it's not just training people, it's instilling a common culture as well, which implies being able to transfer employees from one country to the other in order to accelerate the process. So we know what we want to do. It is taking time. It's one of the most delicate processes, but we have made a tremendous improvement. On question on Turkey, if our shareholders are happy, I'm justified on Turkey. It is nothing personal. If it adds value to the shareholder, which it seems it has, you know, I'm not seeking personal justification. I just want to make the bottom line. Turkey has been contributing and will continue to contribute 30% to group profits. Contribution is something absolute and relative at the same time. If other regions don't perform as well, then the relative element comes into play. And but you know, 30% has been the case in the last few quarters. Measures taken by the government. The only measure that we know exactly what is about, the government has proposed one measure, which is to introduce a Consumer Protection Act in Greece. It is falsely been communicated that this is a first for Greece. Every country in Western Europe has a Consumer Protection Act, and it's imperative that Greece gets a Consumer Protection Act. And we have been exchanging views with the relevant ministry and comments, and I believe the dialogue will result into something that would make sense for everyone. We are expecting to receive a bill which will provide us with measures to handle problematic companies and their debt. We haven't seen the bill yet. I cannot comment on it. What we have seen is the Consumer Protection Act, which looks good, and I think most of the difficulties will be ironed out, if any. You referred to the meeting between the Association of Greek Banks and the Minister of Finance next week. This is the first initial meeting. There is no formal agenda, and I'm looking forward to it.
Thank you. Just to follow up on that, if I may, if the government was to pursue this policy of helping problematic industries as a matter of principle, would you regard that as a retrograde step?
I believe that banks are already trying to help companies that have problems, and there is no legal framework in other countries protecting companies. There's framework for protecting consumers. There's no framework protecting companies, but it's only common sense that banks need to assist the companies, their customers, during periods of recession. It is common sense, and it happens. We restructure debt, we provide them with liquidity. Of course, there are two kinds of customers: the customers who have always had problems and who are using the excuse of the recession to write off debt, which is the vast majority, and the customers who are truly being affected by the recession, and there you simply must help, because you know that in a couple of years' time they'll be out of it, and things will go back to normal. But you know, banks are clever enough to restructure and help companies, and they don't need a legal framework to do it.
Okay. Thanks.
But you know, if there is a bill for this, we'll look at it. I haven't seen one yet.
Thank you. Gentleman here. If we can take several together.
Yeah, sure.
George Prevelakis, I am the National Bank of Greece Senior Research Fellow. Of course, with this opportunity, I would like to thank the Bank of Greece. I am a geographer, and I, of course, am very much interested by the map you have behind you, which conveys.
It's only part of the map. It's just.
Well, if you select a few countries, you operate what we call in geography a regionalization. You define a region, and exactly the idea is about regional integration. Regional integration on the scale of exactly this area, more or less. Do you have the feeling of being a pioneer in the regional integration? Do you feel that you are part of an emerging network of economic actors working in this direction? How do you replace your activity in a wider geopolitical framework?
Thank you. Other questions? The lady over here, please.
My name is Duygu Yücel. I'm a banker and an MBG member as well. I just want to ask Mr. Arapoglou, if on the basics we divide banking products as retail, personal, and corporate, with the parallel to the expansions of MBG, can we say that corporate banking also strengthened?
Can we say that corporate banking also, what was the final part of the question? Sorry, I missed it.
Parallel to the expansion of Southeast Europe and Turkey, can we say that corporate banking divisions of MBG strengthened as well?
Thank you. Okay, next. And the gentleman at the back, please.
Thank you, Kevin. I'm Gerasimos Galetsatos from the European Parliament UK office. Sorry, I cannot speak I have a problem. The previous government offered to the Greek bankers 28 billion euros in order to increase the lending to the people who need them. What was the share of National Bank of Greece, and how you use this money?
Thank you.
Can we take these three?
Yeah, I think it's quite a lot.
Yeah. Regionalization, integration, emerging network. We are not dogmatic to create a region. No? If we can identify value added for our shareholders, we expand. So we don't expand for the sake of expanding. Unfortunately, as loan growth in the countries goes up, you have to move on to another country which is not as leveraged as the previous one. But you need to carefully select these countries. So it is not a dogmatic growth. It is a calculated growth. And in that sense, we decided we're lucky not to go to the Ukraine, lucky not to go to Russia. Had we gone, it would have been bad for our shareholders. So it is certainly not dogmatic, but you need luck like everything in life. The question on, if I understood correctly, on whether the corporate business will become a bigger part of the group. Coming from you, we all know that Finance Bank really grew as a consumer retail bank. Definitely in Turkey, the corporate sector is a growth sector, much more than retail, especially now. As Turkey gets out of the recession, companies will financially be stronger sooner than the average consumer. We'll have to wait for the consumer to feel a lot better to consume at a later stage. So even for this, corporate lending will be a priority for us. With regards to the 28 billion package, liquidity support package, that was the question. I would like to remind everyone that this was not in cash. Perhaps complicated issues such as these are very difficult to explain. This was a package of 23 billion of, in essence, repo facilities where you would give some loans to the Bank of Greece, and the Bank of Greece will give you government bonds that you will repo in the market, so get liquidity. And there were 5 billion, which were counted as a regulatory capital for the regulatory capital adequacy of the banks. Of this, only about, of the 23 billion liquidity package, about 10-12 billion were used by the banks, if my memory serves me. And National Bank of Greece didn't have to participate in this package. We only took a notional 500 million to keep people happy. And we also took 300 million of regulatory capital in the form, again, of government bonds that we took. And I believe that banks didn't use this package as much as it was expected, because this was expensive funding and they could find in the market cheaper funding. Nevertheless, if you look at 2009, loans in Greece increased by about 8% this year. You may recall that at the end of last year, the Central Bank of Greece was under the assumption that the economy would grow at 2% in 2010. People said that they would be happy with a loan growth of 10%. So we are here in a situation where GDP will grow this year it will shrink by 1.5%, and still loan growth in Greece would be something like 6 or 7%. National Bank of Greece, which is the most active bank today in the country, we have made 3.5 billion of loans, new loans in Greece this year. We had liquidity, we preserved liquidity, we planned well, we didn't have to use the package, so we only used it in a notional way.
Thank you. Time for perhaps, okay, there's lots of questions coming. I wonder if we could keep them brief. First of all,
do we get questions from fellow bankers?
No one is excluded.
Okay.
But I'm going to privilege one of my students, actually.
Okay.
Gentleman in the blue, with all of our particular interests.
Yes, thank you very much. My name is Sotiris Zartaloudis. I'm a PhD student at the LSE and the Hellenic Observatory. I would like to focus, my question is related to your final part of your presentation regarding the relationship between banks and the society. And one of the, let's say, accusations that many Greeks have about their banks is that Greek banks usually overcharge about the products, about the loans, the credit cards, the accounts, etc. And there are many studies highlighting the fact that if you compare any Greek bank with any Euro bank, most of the charges are higher. I would like to hear your opinion on why this is the case, and if you think that over time this will kind of decrease and will have a kind of equal, let's say, treatment. Thank you very much.
Thank you. Yes, the gentleman here, please.
It's Christos Megali from Credit Suisse here in London. I'd like to ask the chairman just to look a little bit on domestic consolidation. Do you think that this is, if that happens, will serve a regional strategy? And how feasible is it in the current environment to realize cost synergies?
Mm-hmm. Thank you. And
spoken like a true banker.
Absolutely, impeccably so. The gentleman over here, please.
Hello, Kostas Theodoridis, lecturer in retail management for the University of Central Lancashire. First of all, thank you for your fantastic lecture, and thank you for giving me a fantastic case study to share with my students next week. Well, I would like to ask you, what do you think should be the role as a supporting mechanism for the organization in Greece to expand in the Northeastern Europe and the Balkans, I mean for the National Bank of Greece? And how do you think you can achieve facilitating the expansion of other Greek organizations in the Balkans by setting up some kind of franchises, mutual funds, funds that are going to support this kind of activity in the Balkans. Thank you very much.
Thank you. Do you want to deal with this?
Yeah, sure. Overcharging. First of all, we have to, if we are to be objective, Greece has a lower credit rating as a country than other European countries, most European countries today. Therefore, no bank in this country or no corporation in this country can ever have a bigger credit rating, a better credit rating than the country itself. As such, the credit rating which determines the cost of funding of each bank is a big drag for us. We pay much more expensive to borrow funds compared to other banks same size. Having said that, we are of a smaller size than the average Western European bank, so this makes funding a bit more expensive. It is true that in the last 4 or 5 years, the cost in Greece, the cost of borrowing in Greece, has converged big time compared to other countries, the average. But one of the biggest mistakes that gets done is that we tend to compare, we don't compare apples with apples. We compare some instantaneous cost on loans with rolling averages published by the central bank. So it is complicated. We don't control the same numbers. It is indeed more expensive for us. We are converging, and today, in terms of fees, we are charging much less than anybody else in Europe because of the social pressure. We have stopped charging for legal support. We have stopped charging for the file, opening a file and a new loan. Things are converging very closely to Europe, while Europe, of course, after the crisis, have begun to charge more. And it's turned. As I said earlier, profitability is much more important than market share all over Europe. But I would say that the accusations that we charge much more than we should, I think they're overdone. Κύριε Μεγάλου, domestic consolidation, cost synergies. Well, I don't know when it will happen, because it happens, when other forces come into play. But the cost synergies. If you look at what happened in the Spanish market when Santander, Bilbao, Vizcaya were created, you will see that a lot of branches were closed, shut down. And 2 years later, they opened them up again. And they learned the big lesson that you lose deposits and you lose profitable market share when you shut down the sales points. And most of the focus ever since, in similar transactions, focusing on integrating and cutting costs on the back office. One finance department, one legal department, controls, and technology. So it is not the obvious thing to do is to close branches and reduce staff. About 20–25% of the saving may be some cost because of staff reduction. But the vast majority of saving today comes from integrating the back office. So the social impact, I don't believe that any consolidation in Greece will have any material impact on headcount. The material impact will be on the support functions. Oh, there's one more. Oh, yeah, right. GDP opinion? No, I think we've done this.
We've covered those questions. There's a gentleman's question over here. Gentleman over here about advice on developing in Southeast Europe. And,
all right. Yes. Since 2006, we have assisted about 120 Greek companies invest in Turkey. We've yet to do the other way around, but there's been great interest in supporting, this direction. We have private equity funds which we run out of London, which invest in Southeastern Europe and Turkey. But we don't necessarily invest in Greek companies. We are investing to support the region. And the most important thing we're trying to do, because you have to put the mechanism in play, it is wrong to ignore that, which we have been ignoring up to now, having a customer in Turkey who has operations in Serbia or Romania and not doing business with him in Serbia and Romania. I would rather not increase my customer number, but try and get as big a share of the customer's spending wallet on banking in the region. And this I can justify my presence. I can cross-sell. So, what we're trying to do now is trying to work with the customer outside Greece in every single country, rather than having him do business with another bank in Serbia. Otherwise, you don't need to have a bank in Serbia, really.
Okay, thanks. So, could we take perhaps just two last questions? Gentleman here, on this row here.
Şevket Pamuk. You identify the banking sector as the most, at least, well, one of the most competitive, if not the most competitive sector in Greece. How do you explain that? Is that history? Is there something else there?
Thank you. And the lady at the front here, please. Just have to wait for the microphone to come. I think you need to switch the microphone on.
Ioana.
No, we're not going to hear you. Perhaps you've got a loud voice. Can you simply shout at me, please?
Not much like there. I was wondering, my name is Ioana, I'm an environmental economist. Climate change being one of the most important issues that we're facing today, and the framework of providing bespoke banking products and services. I was wondering if the National Bank of Greece or Greek banks in general plan to engage in carbon financing and taking into advantage the European emissions treaties.
Okay, thanks. For those who didn't hear, it's a question about carbon financing and the European Union's action in this area, yes? Those will have to be the last questions.
Okay. Why did the Greek banking sector become probably the most competitive sector? Probably because competition was introduced sooner, and the private sector came up with very competitive, well-run, well-managed banks, which put the cat amongst the pigeons, as it were, and pressed the public sector to modernize. The advent of the euro, as I said earlier, which brought interest rates down and made and the opening up of the consumer loan market in the country, which wasn't there in the early 90s or the 1980s. So in the last 15 years, it's the euro, it's the competition by private banks, it is the lower interest rates, is the opening up, allowing consumer lending, and the management of the institutions that emerged was very professional. So it became a highly and competition most of the time results into a greater success faster. On the question of climate change, we are not ready to go into carbon financing. We're not ready to however, NBG in Greece has 75% market share of green energy financing. We have developed that in the last 3 years, and we have we have specialized in anything related to wind energy or sun photovoltaic systems, but we haven't gone yet into carbon financing. We're thinking about going into carbon trading, CO2 trading, but this is a different story, not for development. It's something that we're going to have to look at.
Okay, thank you. I'm sorry, the time is against us, but I'd like to thank our speaker very much indeed, that I've learned a lot and a number of major issues have been raised, and thank you also for answering such a diversity of questions. Thank you for your questions. If you are interested in further activities of the Hellenic Observatory, we have the information on our website. We will have a lecture shortly by Yanis Papandreou, the former Minister of National Economy, Minister of Defence, a series of seminars on a Tuesday evening. We hope to see some of you for those activities. Before we finish, please join me in thanking the Chairman and the CEO of the National Bank of Greece for this lecture this evening. Thank you very much indeed.
Thank you.